I published a video a few days ago about why financial advisors really don't invest in crypto. I got a lot of good comments in the comments section and questions and follow up on that video, and I wanted to do a part two to clarify some of the things that I said in the video and shed a little further light on currently why many financial advisors do not invest in cryptocurrency. Stay with me. Even if an advisor is very knowledgeable about crypto and is very comfortable about blockchain and cryptocurrency, we still cannot invest in it, oftentimes because the organizations that we work for and the securities license that we hold. We have something in the financial services industry that we call KYC, and KYC means know your customer. So anytime a prospective client comes and sits down in my office, I basically have to take time to get to know them and also understand the origins of the money that they are transferring over to my care and to my investment knowledge. Essentially, the government put this provision in place because a lot of money laundering and illegal activity was happening through the financial services industry. And if the financial advisor or bank clerk or financial consultant, whoever was dealing with the money, didn't really know the client or didn't really know the customer and wasn't really asking the proper questions, you may end up investing money for ISIS or Al Qaeda. And so several years ago, the government put this provision in place, know your customer. And essentially what it says is it's the financial advisors or wealth managers' responsibility to know the customer and to get to know the origins of that money. And that can be challenging if you don't know the client that you are dealing with. I myself at this stage in my career pretty much deal with clients on a referral only basis. So oftentimes the individual sitting in my office and becoming my client is known to me, even if it's through a secondhand source, but I know their story typically before they come and sit in my office. But essentially what this means for cryptocurrency is that it's a really hard asset class to trace because of the blockchain. So if someone came to my office and they have 30, Bitcoin, where did that money come from? I have no idea, and I can't go into blockchain and basically trace its origin to prove that that money came from a legit source like a W-2 job or the sale of a business or an inheritance. For all I know, it could have come from human trafficking, drugs, and terrorism. So that is yet another reason why many financial advisors and many financial institutions are reluctant to deal with any form of cryptocurrency because we simply can't pinpoint its origins, and we're very afraid of running afoul of KYC, know your client. What are some of the penalties if we violate KYC? On the lighter end, if I open an account and it turns out it's a drug kingpin that is laundering money through my institution, I would almost certainly be fired because I would be accused of not following know your customer, know your client. But that's on the light end. I could actually be prosecuted and end up in prison if the federal government gets involved and it is proven that I either completely ignored red flags that this person was using my organization to illegally launder money, or if I had knowledge that the person was trying to traffic in illegal money. It's not a risk that most financial advisors and wealth managers want to take. And the KYC, know your client, is a provision in financial services and also at the bank level. When you are opening an account, there's always that question, where did this money come from? Where do you work? Where is money going to be coming from in the future? Because they're going after illegal money laundering, terrorism, drug trafficking, human trafficking, all those terrible sources where potential money can come from. And unfortunately, crypto has an entrenched reputation for having an illegal source. So next, something that someone brought up in the comment section that I thought was particularly interesting was that Fidelity now will custodian crypto assets. So I custodian my assets through one of the big major brokers, and they definitely do not custodian crypto assets at this point. In fact, I had a client ask me today about some cryptocurrencies, and I had to tell this individual, unfortunately, I cannot provide those crypto assets, and I have nowhere to custodian those assets because currently the financial firm that I clear through does not allow for me to custodian crypto. But someone mentioned in the comment section that Fidelity does allow for custodian of crypto. And I had to look this up, and I actually had to contact someone at Fidelity today. Some of my clients are custodianed with Fidelity, so I talk to Fidelity on a regular basis. And yes, right as rain, in some states, not in all states, in some states, Fidelity, if you open an account, can custodian crypto assets. Currently, they can only do Bitcoin and Ethereum, but hopefully someday they're saying, they'll be able to custodian other assets. But I thought that was really interesting. That's something new and different, and definitely something I didn't expect. The one question that I have is how, going back to the very first point I made, how do they determine the origin of the Bitcoin or Ethereum, that it comes from a legal source and it's not coming from human trafficking or drug trafficking or, the terrorism? I'm not sure how that happens. I think Fidelity is trying this out. Fidelity likely understands the liability that they are taking on and being the custodian of crypto assets. But as of today, if you live in certain states and you meet certain criteria, you can custodian your Bitcoin or your Ethereum with Fidelity. Next, crypto ETFs. There were a lot of comments about crypto ETFs, and I am aware of crypto ETFs that are currently available on the open market for people to invest in a more diversified way in either blockchain or directly in crypto or in aspects of the crypto industry. Financial advisors are aware of these ETFs, but when you work for either a major broker-dealer or a registered independent advisory, an RIA, there is often something called an approved list of investments that we can invest from. Now, often that approved list of investments has been vetted by an investment committee to make sure it meets certain criteria. Essentially, you don't want to have a blue sky approach when you have hundreds of financial advisors, because invariably someone will make a mistake somewhere and invest the client in either an asset or an asset class that completely blows up, and the organization will be sued. This investment committee and a list of approved investments is basically to protect the organization, to make sure that financial advisors don't get into funny business or invest in things that could create a lawsuit for the financial advisor or the organization. So I am aware of these Bitcoin ETFs and that they are available on to purchase, or these blockchain ETFs. However, in my organization, they are not on the approved investment list. So I can't invest with them on an organizational level, even though they are available on the open stock market. I do have a few clients that have cryptocurrency ETFs, and I have to apply special dispensation to my organization to basically explain why this person wants this particular ETF and how it fits into their portfolio. It's not always a pleasant process to do that. I've done that in the past in other organizations with many clients. It's often a very time-consuming process. It can take weeks to get a response back from your organization. And in many cases, your organization is going to decline the request. So even though these ETFs are available on the open market, many financial advisors are in the same position I am. They can't invest in them simply because their organization will not allow it. Whenever you talk to a financial advisor about risk, whenever I'm speaking to a client or another wealth manager about risk, what I really mean is risk-adjusted returns. And I know the other wealth manager, financial advisor often means risk-adjusted returns. People have spoken about cryptocurrency, especially Bitcoin, in pure form of returns. They say it's the best returns in an asset class in the past decade. That may be true, but it is not the best risk adjusted return in the past decade. You are taking on a tremendous amount of risk for that return. I have to take that into consideration. Why? Because I don't just look at returns, I look at risk adjusted returns based on that client's age, income, risk tolerance, and goals. And if I don't look at a risk adjusted return and something goes pear shaped, I'm sued, the client is dissatisfied, the client loses vast sums of money. I've either lost my job, I've lost my licenses, and I've lost my livelihood. So, yes, Bitcoin may have had fantastic returns over the past decade, but you look at the risk adjusted returns, there are much better asset classes you can invest people's money in and get a great return for far less risk than you take on in investing in Bitcoin. Finally, I want to talk about training because I did receive a question about how financial advisors are trained and do we receive training on cryptocurrencies in our securities license or in our credentialing. And this one's a little bit hard to answer because it's been many years. It's been almost a decade since I was initially licensed, but I have I've passed the Series 7 exam. I have a Series 66. I'm a CFP, so I've passed that exam, and a CPWA, I've passed that exam. Not for the Series 7, not for the 66, not for the CFP, and not for the CPWA. I completed my CPWA training as late as 2022, and there may have been half a paragraph on cryptocurrency. I quite frankly don't remember anything in my training in private wealth in cryptocurrency. I did my CFP a few years before. There was nothing on cryptocurrency. So in a lot of our education, credentialing, and training, we are not taught about cryptocurrencies or blockchain. And the only reason why I know about it is because I actively seek out the information. We do have to do a bunch of annual CEUs, both for my Series 7 and Series 66 license and for the CFP CPWA. Probably between all of those four licensures and credentialing, I do probably 100 hours a year of continuing education. And there's never anything on crypto or on blockchain or anything like that. I tend to find out about events or activities and speakers for wealth managers, and maybe they will have a 45-minute session on cryptocurrencies, and it's often the creators of these Bitcoin ETFs or blockchain ETFs that want to educate financial advisors on cryptocurrency. I also spend a lot of time on YouTube and on social media. There's a lot of good education on cryptocurrency, blockchain, and other forms of cryptocurrency. But, you know, it is really shocking to be in this industry and to realize that there's so much happening in a specific sector and not receive much education training about it. Financial advisors really don't talk about it unless I bring it up or unless specifically I'm in a training event with other financial advisors that is targeted towards blockchain or crypto. We don't really talk about it. We talk about everything else. We talk about real estate. We talk about, you know, deferred sales trust. We talk about mutual funds, ETFs, stock markets. We talk about alternatives, private equity. We talk about hedge funds, derivatives. You name it, we talk about it. Crypto just isn't one of those things that we discuss, and it's for the multitude of reasons that I've outlined in these two videos. So let's keep the discussion going. Tell me what you think. Tell me what you like and what you don't like. And if you found this information useful, please like, share, and subscribe.